Welcome to today's webinar entitled Valuations 201. Today we'll be covering valuation considerations for investment in property holding companies. This is the second in our series of business valuation webinars, and we invite you to review our first one, which is found at our YouTube site. My name is David Ianzi. I'm a partner at Henry Warren. I'm a CPA and a CBV, and I'm joined today by my colleague, Brock McDonald.
Thanks, Dave. As Dave mentioned, my name is Brock McDonald. I am also a CBV, and I'm a senior manager here at Henry Warren who helps manage the valuation practice alongside Dave.
So for today's presentation, the first note of business is our disclaimer. So this presentation is strictly for informational purposes. Every circumstances are unique, and we recommend you discuss your specific situation with your professional advisors. So let's move on to what to expect today. So we'll cover off what is a business valuation, what's a holding company, valuation approaches, the adjusted net book value formula, which is the very specific approach used for valuing holding companies, other considerations within the adjusted net book value formula. We'll cover off an example, and then we'll end it off with a Q&A session.
Awesome.
So at the beginning, essentially, what is a business valuation? Well, this is defined by the Canadian Institute of Chartered Business Valuators. A business valuation is, in its simplest form, an estimation of what a company is worth. There is a formula, and the formula essentially for the definition is driven by we're searching for the highest price in an open and unrestricted market between informed and prudent parties at arm's length who are under no compulsion to act, and it's stated in terms of cash or cash considerations. A holding company is a company that holds assets such as cash, marketable securities, real estate, investments, and also investments in operating businesses. Those assets and these assets typically generate passive income. They do not have active business operations. While it can own an interest in an active business operation, it itself does not have an active business, and there's no commercial goodwill. And it's commonly implemented as part of a tax planning strategy or for creditor proofing processes and reasoning.
Awesome. Thanks, Dave. So now that everybody knows what a business valuation is and what a holding company is, we'll talk about some of the different business valuation approaches out there, as well as which ones are applicable to holding companies. So there's three different business valuation approaches. There's a market-based approach, cash-based approach, and asset-based approach. The market-based approach is rarely used as a primary approach and is more commonly used as a secondary approach or a test of value to a cash-based approach. The market-based approach is really looking at previous company sales, precedent transactions, or public companies that are traded on the open market and trying to compare your company to that company. It can be difficult to do, and it's not applicable to holding companies. The cash-based approach, this is the most common type of business valuation approach. And it's generally used for operating companies that have sufficient cash flow and have commercial goodwill, not typically used for a holding company. The last is the asset-based approach. So this is generally used for companies without commercial goodwill. They don't have large business operations, and really the value of the company lies in the underlying assets. This is the type of business valuation approach that is applicable to holding companies. We'll talk a little bit more about the asset-based approaches now. Specifically, under the asset-based approach, there's two different sub-approaches. One, the liquidation approach, and two, the adjusted net book value approach. The liquidation approach is for when a company is not a going concern. So essentially, the company is not going to continue operations. They're going to wind up distribute the assets. An adjusted net book value approach is for a company that is going to continue on with their operations. We'll take a quick look at the liquidation approach and talk about that briefly, and then we'll take a little bit of a deeper dive into the adjusted net book value approach. So under the liquidation valuation approach, there is two subcategories once again, a forced liquidation and a voluntary liquidation. Really, these depend on who controls the liquidation. A forced liquidation would be controlled by a third party, such as a creditor or a bank. Think of bankruptcy, for example. A voluntary liquidation would be controlled by the shareholder or shareholders. Let's say they're done with the company, they want to wind it up, they want to sell the assets, distribute the proceeds, etc. Under either of these approaches, the following steps are taken. So first, we got to find the net realizable value of the assets. What's the fair value of all the assets? What kind of cash are we going to get for them? Then we have to deduct the liabilities. What are we going to have to pay out with that cash we get? Is there any AP or accounts payable owing to vendors? Is there amounts owing to the bank, etc.? Third, we're going to deduct any liquidation related costs. So these could be professional fees, lawyer fees, taxes other than income taxes, etc. And then lastly, we would deduct all the income taxes applicable to get to the net after-tax proceeds available for distribution to the shareholders. So in a nutshell, that's the liquidation valuation approach. I'm now going to send it back over to Dave, and he's going to dive into the adjusted net book value approach.
Thank you, Brock. As Brock had mentioned earlier, the adjusted net book value approach is a common approach, and it's the most common approach used for valuing a holding company that's a going concern. It is equation driven, and we'll walk through the standard schematic here. However, it still requires professional considerations when carrying out the calculations. So at the onset, we start off with the shareholders' equity. That's essentially the book value of the company, or its adjusted, or its book value. And what we're looking to do is derive the adjusted net book value. And so then we would move through a series of considerations as we get to the ultimate goal, which is the fair market value of the corporation. So the first step is to add the economic value of the tangible assets. So assets that are held at their historical cost do not reflect their economic value or their fair market value. And so we would adjust to that number and then deduct out the book value, which is already based in the initial shareholders' equity. We would then deduct the book value of the intangible assets. And as we had noted earlier, there's no commercial goodwill considerations. Now, holding companies can have historic goodwill from other transactions that may have occurred, or at one point in time could have been an active company with an active business and carried on its goodwill. However, when we calculate the value of a holding company, we deduct out the book value of the intangible asset. But we still consider the tax shield related to that. There is still a benefit for having that asset, and that's the benefit of the tax deductibility that comes from that asset itself. And so we review and reflect the tax shield that's gained. We add back then other economic, like the economic value of other tax pools that can be tax losses, and we'll cover those off momentarily in other slides. We look then at the liabilities, so we add the book value of the liabilities and then deduct out the economic value of the liabilities. And so therefore, not only are assets important in this calculation, but as are the liabilities. And we would look at whether the stated or book value of those liabilities truly reflect the value of that liability. Interest rate differentials really come into play there. The last consideration is then looking at just other tax considerations in terms of future tax liabilities. And generally, that's the foregone tax shield. But again, we'll cover that off momentarily. So the first step to look at then here is just the economic value of the tangible assets. So we have marketable securities that can have unrealized gains or losses on your books, and we tend to then adjust those to their fair market value, which is their realized value. As well, we would look at inventory to determine whether there's any impairment or obsolescence that needs to be considered. The other main consideration, and we see that whether there's interest rate volatility or if people have had loans that have been on their books for quite some time that do have an interest rate attached to those loans. And we would look at whether those terms differ from the market rates. And if there are differentiators and differences, rather, then there would be a calculation that would be carried out to determine whether the fair market value of that loan is similar or different from its book value. The last item that we would consider here then is real estate with unrealized gains and losses. So real estate generally is, as most assets are recorded at their historical cost, and then one would assume that they would increase in value over time. That value is not trapped in the financial statements, and so an adjustment to the realized value would be recognized within this calculation. The key consideration here is that as business valuators, we value businesses. However, we are not real estate appraisers, and we always recommend that a real estate appraisal be done to determine the true and best use fair market value for that specific property that's included in the holding company. The next item to look at are the economic value of the tax pools. So here we would look at, whether there are non-capital loss carry forward or shred balances. Each of those have value to a business. The non-capital loss carry forward would be considered as to when the timing or the utilization of it, its expiration, and what its effective tax rate is. And so an analysis would be done of that. When could we ultimately realize on the tax loss carry forward? At the same time with shred balances, what is the expectation of realizing on this and what is the time frame? And a calculation would be carried out there. The other key is just the applicable tax rate in effect, and essentially whether it's a capital loss or a non-capital loss as well. The tax rate really comes into consideration in including future and potentially enacted tax rates or tax differences. So if there's an expectation that there's going to be a tax rate change or it's been announced, but the date is at a future date, those would need to be considered as well. When we talk about liabilities, it's very similar to when I talked about the interest rate differential for loans. The key here is when you look at your debt and whether it's actually reflecting a market interest rate. If the rate that you're currently paying on your debt is different, lower or higher, you can either have a discounting of that debt or the value is higher, and therefore you have a larger liability because over time you'll pay out more cash because of the higher interest rate than the economic face value of the debt. The last item here then is pension liability. So a pension liability, although generally carried at certain costs and then obviously payments that have been made and the considerations for the liabilities, when a valuation is done, it is important to get the pension itself valued one more time. And this would be done by an actuary. An actuary is a specialist in the valuations of pensions and related pension liabilities. And we would always recommend that if there's a pension to be considered, that an actuary gets involved as well.
Sure.
The last item here then is just the economic value of future income tax obligations. This is essentially the consideration of the foregone tax shield. This arises when there's a difference between the economic values, the fair market value, and then the book value of tangible assets. So if somebody buys an asset, they ultimately get to claim the CCA at the stepped up cost, the fair market value. They've purchased it for fair market value, then that becomes their cost base and they can depreciate that. There's a tax benefit to that purchase. When somebody buys a share, so if somebody were to buy the shares of a holding company that held an asset that had increased in value, while they pay up the stepped up cost based on the purchase of those shares, they don't actually get the benefit of claiming the CCA on the stepped up cost itself. And therefore, then we would do an analysis to consider, what has lost the lost tax shield, in this case, the foregone tax shield. So although you have paid higher because of the increase in value of the asset, you've not realized the tax benefit, and therefore that would generally be deducted from the value of the holding company to reflect the true value of the asset.
Okay, that's great. Thanks, Dave. So we took a look at the formula and Dave walked us through some of the key aspects of the formula. So just before we jump into an example, there's a couple other considerations I wanted to go through in relation to adjusted net book value in holding companies. The first is this concept of latent taxes. What latent taxes are is essentially notional taxes on unrealized gains. So for example, think if I had marketable securities or investments in stocks, those stocks might have gone up in value. However, I haven't sold those stocks yet. So I have this unrealized gain, but I haven't actually incurred the tax on that capital gain yet that I might incur down the road. So that's what latent taxes is referring to. In general, in holding companies under the adjusted net book value approach, we're not typically deducting latent taxes from the economic value or the fair value of the assets unless those assets are considered redundant. So in my example, marketable securities, possibly that's considered redundant. It's really just excess cash that's been invested. However, on the flip side, let's say you have a company that owns a couple of real estate properties in Ottawa and rents them out as a rental property. Well, those real estate assets are really integral to the company, and that is the purpose of the company. They would not be considered redundant. It's important to know that it's case by case on whether an item is considered redundant, an asset is redundant or not, and it depends on several factors on whether that tax will be deducted or not. As Dave mentioned in the tax pool, it's similar here where we need to consider the timing of when those taxes will be incurred and the likelihood of those taxes, the tax rate in effect, any refundability of the taxes, and therefore we could apply a discount or a present value to the expected taxes. The last consideration here is investments in operating companies. So we're talking about holding companies, but as Dave mentioned, sometimes the holding company could be invested in an operating company. Essentially, the holding company could be on the top, owning the opco. In this case, when we're valuing the holding company, we need to be also having a value for the operating company as it's an asset of the holding company. Typically, that investment in the operating company is valued using a cash flow based methodology, such as capitalized cash flow or discounted cash flow. We're not going into detail on those approaches in this session, but if you want to hear a little bit more about those approaches, you can take a look back at our previous valuation webinar or stay tuned in the future for a deeper dive into those ones. We do need to consider a minority discount. And so without getting too into the details, a minority discount is when you own a non-controlling interest of the company. You may have a discount on the value of your shares for not having control of that. Lastly, similar to the previous slide, you need to consider whether notional or latent taxes would apply. In this case, it depends on the timing and expected disposition. If the operating company is going to continue on and the holding company is going to continue to own that, then that would have an impact versus if it was going to dispose of that investment right away. We also need to consider other possibilities of tax deferred opportunities, such as a wind up into the holding company. So we've talked about some theory on adjusted net book value and on holding companies, on what a holding company is. And hopefully this next example I'm going to walk you through will help cement some of these concepts and help you visualize some of the numbers flowing through. Now, this is a very simplified example I want to point out. So like Dave said, every time we do an adjusted net book value, there's case-by-case specifics and there's professional judgment involved. However, I figured if we walk through a simplified example, it might help. So the first step is we're going to take a look at the balance sheet and we're going to be looking for assets or liabilities that might have a fair market value different than a book value. We're going to have to investigate those, talk to the client, possibly get appraisals. So when I'm looking through this balance sheet, we see this company has a lot of cash. They've probably built that up over time. Cash is cash, so no consideration there on a fair value change. Prepaid expenses would have no adjustment. Real property, so that one would raise eyebrows. It's very uncommon that a real property would have a fair value equal to the book value on the balance sheet, so we'll have to look into that. Loan receivable, well, automatically I'm thinking, what is the terms on that? Is it at a market interest rate? Goodwill, we talked about that goodwill reduces the value, so that will need to come out of the adjusted net book value. It may be that this company used to be an operating company and that's why the goodwill was built up. There may be tax benefits in the future on that goodwill as well. Accounts payable, no adjustments there. And then lastly, long-term debt. Again, we want to know what the terms of that are. So we've got our appraisals, we've talked to the client, and we've come up with some more facts here. The real property has an economic value or a fair value of 7.2 million, a UCC base of 2.5 million, and a CCA rate of 4%. Some acronyms in there. Essentially what they mean is it has a tax base to defer or to amortize in the future rather of 2.5 million, and the amortization rate is 4% per year. Long-term debt had a coupon rate of 6% and 5 years remaining. However, the current market rate interest is 8%, so we'll have an adjustment there. All other assets and liabilities have a fair market value equal to their book value, and the company has an income tax rate of 28% and a cost of capital of 17%. So a lot of factors there, and on the next slide, we'll kind of walk through how that all falls out in the calculation. So we start with the shareholders' equity of 5.1 million. That's directly from the balance sheet. Add the fair value or economic value of the real estate, deduct out the net book value of the real estate, essentially giving that fair market value bump on top of the equity. Deduct out the net book value of goodwill, as Dave discussed, and then add the present value of the tax shield on goodwill. So that's the benefit of being able to amortize that goodwill into the future and get tax breaks on that. Then we'll do the foregone tax shield. So David walked us through that formula, and essentially the value is coming down by 223,000 due to the tax shield being higher on the fair value than the book value of the asset. And therefore, a difference in the purchase of shares versus assets. Next, we're going to add back the book value of the long-term debt, and we're going to deduct out the fair value of the long-term debt based on the market terms, which is derived from a present value formula. With all that to say, we've had some additions and some subtractions to equity, and we get to an adjusted net book value of just shy of 6 million, compared to our shareholders' equity of 5.1 million. So hopefully that example kind of helped cement the learning of the adjusted net book value formula today. So we'd like to thank you for coming to the webinar. If you have any questions, now's the time to post them in the Zoom chat. We'd be happy to answer them. If you'd like to subscribe to our YouTube channel, you can see some of our past webinars, or follow us on the LinkedIn to stay in the know and see some of our future webinars as well. I don't think there's any questions. Do you see any questions, Dave?
I don't.
Okay.
Well, if there are
Well,
no
that's great then.
questions,
I hope you enjoyed your time today, and tune in for any future webinars.
yeah, we appreciate that. Thank you for taking your time today. Have a good day, everyone.